Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting. Appreciate you joining us for what we're going to call Market Minutes. And this is just a hopefully a relatively brief summary of our markets and kind of our basic observations therein. We've decided to kind of separate these comments from our chart discussion, which we're going to leave in its own separate format. To try to break apart for those who just want the market commentary and those who like to see the visual parts of our analysis. So hope you enjoy. Please see our disclaimer for important information. So last week the Dow was up 1%, the S&P 500 was up about 1.9%, and the NASDAQ was up about 3.7%. We had, for the year, the S&P is still down about 4.1%. The Dow is actually down about 9.4%. The bond market, basically year to date is up about 6% if you look at the Barclays aggregate. And then high yield for the year is down about 2.3%. Leverage loans are down about 3.5%. And if you look at international markets, they're also fairly weak, as are small caps. Small caps for the year down almost 15%, whereas basically the international index, if you will, is down about 11.5%. So, as we look at some of the economic data, we got retail sales, which were up about 17.7% in May. And that was really more than twice the consensus estimate, a very strong number. So we had a lot of pent-up demand with about a 44% increase in auto sales, 29% increase in dining and drinking establishment sales. Even though those overall sales are still well below the monthly level that we had before the COVID pandemic, the strong recovery and demand has kind of fueled some optimism that the economy can return to normal a little bit more quickly. And in addition, we had some regional manufacturing sentiment indicators, which were also ahead of expectations. We got there's a number of reasons on the margin that we can feel somewhat good about things. Mortgage applications hit the highest level that we've seen since 2008. Interestingly enough, that comes at a time where we're getting more anecdotal reports of credit being a little bit tighter for individuals. Retail sales, we already talked about. Businesses added 2.5 million jobs in the month of May, which was very much a surprise. And speaking of surprise, the Citigroup's Economic Surprise Index is basically cut its losses in half. So it's the highest reading that we've seen. I mean, in terms of number of positive surprises relative to consensus since the beginning of 2018, which is really something that we did not expect. So obviously that's manifested itself in the market. The S&P 500 was up 39% from its March 23rd low. And despite all of what's happened here in the last couple of months, the S&P 500 index is only about 8% below its high from February 19th, which is really amazing considering the long journey that we've had. More economic data that we got last week. We're talking about retail sales. If you exclude food services and related industries to food service delivery, year over year retail sales are only down 1.4%. On the manufacturing side, capacity utilization is about 65%, a little bit less than that, and that's significantly below the level that we had during the financial crisis. It doesn't really have a lot of positive implications for investment coming out of the business sector. We had about 1.5 million people that filed for unemployment insurance, and the continuing claims number is still pretty high, almost 19 million people. So while we've had a decline in crude production, we have seen prices begin to pick up. So we're actually on, for crude West Texas Intermediate, we had briefly broached the $40 a barrel level on Friday before dipping at the close. And, if you look at other things, 7-day, well, basically, we had a little bit of kind of momentum building amidst all this volatility that was kind of stunted on Friday as we had some reports of some increased COVID-19 cases and the rate of gain in caseloads for Texas, including for Texas and for a lot of the southern border states and Gulf states too, took a little bit of the steam out of the market. And we've seen a 7-day moving average of caseloads turn up, and it's now about 25,000 cases per day again. And ironically, if you exclude the New York area, which was formerly the hot zone, I mean, we're hitting new records. So we're, again, just, and other things that we're tracking, obviously, state and local financial circumstances. We are expecting a stimulus package to come somewhere in between the summer and Labor Day recesses that will hopefully bail them out. Just a few comments to really some economics and fundamentals that, again, are produced for us or compiled for us by our friend Sandy Leeds over at the University of Texas. He says out of the last 14 recessions going back to the Great Depression, only 5 have lasted longer than 1 year, and the median is about 10.5 months. And during the last 14 recessions, the market has had negative returns during half of those and positive during the other half. So that's fairly inconclusive. But having said that, after the past 14 recession, stocks were higher 3 years later in all 14 cases. So that bodes well for patience. As he says, in the last 8 recessions, it has taken between 7 and 17 quarters for the S&P 500 earnings to return to their pre-recession highs, with a median of 11 quarters. So, and we know that we're expecting it to take a while. We've had a lot of erosion in S&P earnings, and it's going to take a while for those earnings to come back. Another interesting thing in the S&P 2000, the Russell 2000 index, which has a lot of the small companies in it, that index is down almost 15% for the year, and it's probably one of the worst performing indexes domestically that we've had. But an interesting statistic, again from Sandy, is that 42% of the companies in that index are not even profitable. So there you go. As we look out, observations and expectations, I guess, the depth of the economic plunge has been a little bit milder than we anticipated. The rebound subsequently has been a little bit stronger. Retail spending, that was obviously a surprise, which kind of goes into that thinking. So feel like we've pretty much reached the bottom of the recession in April. As we look into the second quarter for economic growth, the drop may not be as precipitous as we formerly thought. Some estimates had us down 40 or 50% on an annualized basis, and that number may not quite be that low. Maybe 35, perhaps a little bit better than that. We just don't know. It certainly, if we get a vaccine, or the rhetoric increases and there's more optimism to get people to spend and et cetera, that third quarter economic growth could actually increase somewhere between maybe 10 to 20%. We just don't know. But if the vaccine becomes widely available as soon as early 2021, I would expect growth to increase much more rapidly. I think we're going to see some pretty strong data in May and June and July when all of this stuff gets reported. Just kind of drawing on what we've seen already. And as I mentioned before, I'm pretty sure that Congress is going to pass another round of fiscal stimulus. We're going to get, state and local government support. But we're probably going to have to compromise on some things like liability protection for corporations, that they don't get sued if there's COVID-related impacts, and unemployment insurance, and maybe some more paycheck protection programs, or PPP, for businesses. We know the small businesses have proven relatively fragile to some of the shocks, so we have to watch that. And clearly, on kind of, if you look international sales now comprise almost 30% of S&P 500 revenues, and we've seen kind of this collapse of the global tax negotiations. So this could lead to a new round of trade wars, and obviously there's a lot of antipathy towards China right now, and I think for all intents and purposes, the trade deal that was previously negotiated, that was given it kind of gave some optimism entering the year, has kind of basically gone away. So, and we've got more, I guess, we have more surveys and opinion polls that suggest that the Democrats are in stronger position now heading into the presidential elections, that and people are beginning to draw some conclusions as to what implications that might have for corporate America. And so the idea now is that there's going to be trillions of dollars of net new costs on businesses, perhaps investors. We don't know obviously what's going to turn out, but perhaps a migration upward in the corporate tax rate, as well as some taxation on capital gains and dividends at ordinary rates for some high level income Americans. And so with that, I think we still have fairly strong statements coming out of the Federal Reserve that are going to help us, but it's going to take some time to close the gap. And low borrowing rates and interest rates will continue to support stocks, but it is going to be, I think, a little bit bumpy from here, a little bit more volatile. But that low interest rates are not in and of itself sufficient to justify higher prices for higher value stocks without a significant increase in long-term profit expectations. And so what that means is that profit expectations have fallen off a cliff lately. And if we want to have some real teeth into this market recovery, if you will, we're eventually going to have to turn the tide on that profit expectation number and have that begin to become more optimistic. But those are just a few comments, from our perspective. And there's obviously a lot more information that lays behind this, but felt like that was probably the most interesting of the data for the last week, and hope you enjoyed this. And we hope that you come join us next week for our market minutes. And please see our information there, and we welcome your comments and your thoughts, and hope you have a great week.